value from success, growth in discovery. Golden Arrow Resources is a well-funded gold-copper exploration company with proven management and prospective properties in Chile, Argentina, and Paraguay. Golden Arrow trades on the Toronto Venture Exchange, symbol GRG, on Frankfurt, symbol G6A, and the OTCQB, symbol GARWF. For more information, visit us at goldenarrowresources.com or call Sean at 778-686-0135.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Victor Adair, just retired from nearly 50 years of being in the brokerage business in BC. His website, victoradair.ca. I see you've been posting more and more content to your new website, victoradair.ca. I know you had to shut down the Polar Futures Group website when you retired from the brokerage business, but will that be different between the Polar site and your new one? And by the way, if people want to read any of the posts you wrote for Polar during the last 3 years, you can find them all archived here on HowStreet.com. Just look for the Victor Adair author profile. So what is the difference between what you were putting out when you were retired, while you were retired, and what you were putting out for the brokerage firm while you were working there?
There won't be a lot of difference in that for the last 3 years at Polar Futures Group, I was posting my weekly trading desk notes, which were sort of a review of the different markets that I follow, sort of global macro, and things that I was doing with my own accounts in those markets. With my new site, I'm going to add a couple of things. One, I'm calling, what did I say? It's not so much profiles, but, trading principles. And that's like my rules. Things, not only rules, but sort of the process that I use and why I do what I do with my trading. And then one other one, I'm calling this the trading life, and it's a little more personal. It's kind of like, what is it like to trade for a living or to live for trading, which are the sort of the two things that I do. And, it's not easy. It is not it's not a job where you get a regular income. In fact, it's a job where you can lose money. So, you have to make some adjustments for that. But the intention, Jim, of what I'm trying to do with victoradair.ca is to give my readers some ideas that they can develop into their own trading, their own investing, whatever. Maybe give them some perspectives on markets, maybe give them something to think about they hadn't thought about before, and hopefully by doing that, by being better informed or differently informed than they were to be otherwise, they'll make more money with their own trading and their own investing. So that's the objective. We have about 1,000 people now that look at the site, and I'm just really starting to build content on it. I mean, I have a full-time job as a trader, and I've kind of taken on this full-time job of being my own webmaster. And, you can teach an old dog new tricks, like how to use different software programs. It's just that sometimes the old dogs have a memory problem to remember how to do all those new things. So it's been fun and a bit of a struggle at times to get the website up and running, but it is, and it will get better as we go forward. My key operating principle, Jim, is that it is a work in progress.
Since we last talked a month ago, there have been two big developments, the American presidential election and the news that they have two different coronavirus vaccines that look very promising. The major North American stock indices have rallied to new all-time highs. How do all these things match up, or do they? Let's maybe go back not so much as all the way to the beginning, but just maybe into middle of last month, when we last talked. About that time, as we went into the end of the month, the stock markets generally, and let me just say this, there's a lot of correlation in the markets right now. For instance, the Canadian dollar goes up and down pretty much in lockstep with the stock market. That's what I mean by correlation. So the market broadly was
what I'd call de-risking going into the election. Certainly the last couple of weeks of October. De-risking was looking like people were selling stock. Maybe folks were saying, who knows what's going to happen. We've had a hell of a run. Let's take some money off the table. Let's pare back our risk or whatever. That sort of thing. And the other thing that we saw that was stuck out like a sore thumb is that the volatility metrics, what's the VIX trading at, that kind of thing, people would understand that. Volatilities across markets were jumping as, nobody wanted to take on a massive position in front of the election, just in case it didn't go as planned. So then I guess the low was made right at the very last trading day of October. And then we had the election 2 days into November, on the 3rd, 2 trading days, I should say. And the stock market continued to rally. If I just use the Dow here for an example, it rallied about 2,500 points from the last day of October, the lows. In 4 days, it rallied 2,500 points. So the market was kind of maybe a sigh of relief. I'm saying, the market, whatever your political views, I'm not going to try to dissect that here, just to say here's what the market did. So the market rallied, and then we had the virus news, and that came out Vancouver time about 4:30 in the morning, well ahead of the opening in the cash market in the United States, in what we used to call the floor. And at the highs on that overnight session before the markets opened on Monday, the Dow had rallied about 4,000 points in 7 days from the lows of October. So a pretty spectacular move on those two events you just mentioned, the presidential election and the virus news. So, where does that put it? That put us now, in my view of things, the market's kind of price for perfection here. I think the stock market, to keep it in real general terms, is looking past the prospects of kind of a dark winter with the virus spreading, the economy slowing down, lockdowns, that sort of thing. Looking past that, call it, to the bright sunny times that we will have next summer when the virus is banished and everybody's vaccinated and we all live happily ever after, that sort of thing. So I think there's that kind of psychology in the market. We did see massive capital flow into the stock market last week. The sentiment on the market is extremely bullish here. The put-call ratio is like, who needs puts? Everybody's buying calls. And, so we're in this condition. Now, you can obviously you can tell from the tone of my voice, I'm a skeptical person, and I'm inclined to think that maybe if the market's really going one way, something may come along and cause it to go the other way. We have seen massive rotation in the stock market. I've just been talking about the broad indices, but you look at something as, here's 2 stocks, okay? Since the beginning of September, and we've talked about this before, there was a key turn date back then. Since then, the share price of Apple, one of the leading lights in the American market, is down about 13%. The share price of Caterpillar Tractor, sort of the antithesis of Apple computers, is up about 20%. I just use those 2 stocks as I picked 2 to try to illustrate to folks that we've had this real change in, let's say, the NASDAQ is down while the Russell small cap index is up huge. The ratio between those 2 things has made it an amazing move. So there's a lot of things going on under the hood, as they say, but as it stands, the broad indices, as you said, and the Toronto market as well, by the way, have rallied to new all-time highs following the election and following this vaccine news, and that's where we are now.
We'll have more with Victor Adair right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Victor Adair. Victor, the gold market rallied to a 2-month high after the election and then dropped more than $100 an ounce when the Pfizer vaccine news came out. What are the major issues impacting the gold price right now, and where do you see it going?
Yeah, the gold markets, again, why don't we do what we just did with the stock market and kind of go back to the beginning or something? I mean, the gold market back in 2015 was trading just above $1,000 an ounce, and it doubled to the high that we made beginning of August of this year, at 2050. A good part of that run came this year, and I'm going to say that rally that we had this year was largely the result of historically massive buying of gold ETFs in the North American and the European market. The amount of gold ETFs that were bought between March and August of this year, while the gold price rose about $600, was a total of about 750 tons of gold, which that's a lot of gold. And that was more gold than had ever been bought in any previous entire year, just to give you some scope as to how much gold that was. So we had a real run in gold, so to say, doubled from 2015 to where we are now, with a big part of that coming this year. And the buying from the ETFs was so important. It's called investment demand. And one of the reasons that was so important is because during this year to date, the retail demand from two of the biggest markets, that's India and China, is down well more than 50% of what it typically is. So, if you're gold bullish, you got to say, thank God we had the ETF demand, or we'd really be in trouble here. The gold market, I think, when it fell $100 on that virus announcement, and by the way, gold fell over $100, the bond market fell very sharply, the Japanese yen fell very sharply, and so did the Swiss franc. Japanese yen had been around about a 4-year high when that news came out, and the Swiss was about a 5-year high. All four of those things are seen as havens. And the quick take on the virus was that, hey, we don't have a problem anymore. This virus thing that's been such a problem, it's going to go away. And, you could say, well, hang on, it's not going to happen that fast. But there was, it seemed, that kind of a reaction in the market, on the psychology of the market. So gold took that $100 hit. I have to think that gold has been struggling a bit here. I mean, it has not reacted to a weaker U.S. dollar that we've seen over the past 2 months. I mean, gold, I think, hit not gold, but the U.S. dollar index hit a high, a 3 or 4 year high in March. And, right now we're very close, like, whiskers away from the market dropping to a good 2.5 year low. And gold hasn't been reacting very positively to that. I'm not negative on gold. I'm just looking at the price action and saying, it seems like it's struggling a bit here. I would say if it breaks the $1,850 level, which has been a real support for gold, that'd be kind of grim. Actually, while we're on metals, I should mention that copper traded to a 30-month high, up around 3.25. I think we got on copper, something like that. But to put that in perspective, I mean, it's been a brutal bear market for the base metals. I mean, copper was trading $4.50 a pound back in 2011. That was an all-time high. And, since then, until I guess the $2 level we hit in March of this year, it's been a real tough market for the base metals.
The U.S. dollar hit a 3-year high in March, but has fallen over 10% since then and is now near one of its lows over the past 2.5 years. What's causing these swings in the U.S. dollar? And some people are saying it's going to go much lower. Do you agree?
Well, the dollar hit its high in March when people were freaking out, to use that technical term, over the impact of the virus. Stock markets took a big swoon. And people went to the relative safety and the liquidity of the U.S. dollar. So that spiked the U.S. dollar. And then since then, as you say, the U.S. dollar has weakened about 10% from those highs we made in March. And part of that weakening, I think has been, what we see is the speculators in the currency markets are certainly positioned, bearish the U.S. dollar. Sentiment is very bearish on the U.S. dollar, and the consensus view, going ahead here from the different analysts is bearish. Citibank, for instance, who, that's one of the big companies that advises in markets. Citibank is forecasting that the U.S. dollar will fall 20% in 2021. The rationale for their view is that they think the vaccine, the silver bullet, as I call it, is going to change everything, and certainly would revive global trade. They think that Biden is generally, because we haven't got all day here, I'm saying generally Biden is generally bearish for the U.S. dollar, and that the Federal Reserve will remain dovish. In other words, they'll keep interest rates really low in the United States while the rest of the world grows faster than the U.S. I just mentioned that the Japanese yen had been at a 4-year high before it was hit with the news on the virus. All of the Asian currencies have been rallying this year. The Chinese currency, the offshore RMB, was at a multi-year low in March, and it's up about 10% since then. So as the yen and the renminbi go in Asia, so will a lot of the other currencies go kind of move in the same direction as they do. So we've seen real strength in the Asian market. I'm inclined to, again, be a little skeptical about this almost universal bearishness on the U.S. dollar, but I don't have a big commitment on that at the time. Actually, I'll just tell you that right now, what my very short-term commitments are. I am short of the stock market, thinking it's gone up here too far too fast, and given that we're virtually at all-time highs, I have a modest position, and I'd throw the towel in on that pretty quickly. And I'm long on the bond market, and maybe we'll get around to talking about interest rates in a minute, and I can tell you why.
The Canadian dollar was down 68 cents, or down to 68 cents in March. Now it's up to 77 cents. And last week hit one of its best levels in 2 years. What's driving the upward trend in the loonie, and what could cause it to keep it to go higher?
As I mentioned earlier, the Canadian dollar is very highly correlated with the ups and downs of the S&P. And, there's just this broad sentiment swing in the market. You could call it, on some scales, you could call it fear compared to greed. On others would be, if the market's fearful, then it's risk off. And if it's greedy, then it's risk on, that sort of thing. So, if the general psychology in the market is risk on and the stock market is going up, then the U.S. dollar is generally weak. And that's such a broad generalization to be virtually useless, but that's just how it's been. This year to date, Canada has gone down when the stock market's gone down and gone up when the stock market's gone up. It's probably Canadian dollar correlation to the S&P is higher than any other correlation that it has. And it's certainly correlated historically to the commodity indices, say the CRB index. As I was just saying moments ago, the copper market in particular, but commodities generally have been in a brutal bear market here since the high made in 2011. And funnily enough, the Canadian dollar, if you remember fondly, was traded a high of about $1.05 or $1.06 in 2011, and we got all the way down to 68 cents here in March. So the Canada's been in a bit of the Canadian dollar, I should say, a brutal bear market during that period of time. The CRB did break out to new 2-year highs here, this week. Certainly the agricultural markets and specifically the soya bean market has really been given a boost to the commodity index. And, over like a 20-year time frame, you'll find that the Canadian dollar's got a pretty good correlation with the ups and downs of the broad commodity indices. So you got an environment here where the U.S. dollar has been weakening. Canada's got a bit of a bid. Up traded, as you say, above 77 cents. It was a 2-year high that we made there. It's slipped back a bit since then. I would say, where does Canada go from here? I'm skeptical at 77 cents. But one of the things that I do with my trading, I have some views as the market's going to go up or market's going to go down, but something that always overrides those views is how I manage the risks that I take in my trade. In fact, what my job really is trying to identify risks and then manage them. So I just got through saying, Canada is highly correlated with the stock market. If I'm short the stock market, I could also be, or I could be instead, short the Canadian dollar market. So to be short both of them together at the same time means I've sort of doubled up the same trade. So I'm not short of Canada at the moment, but given that I'm short of the stock market, if I didn't have a stock market short on, I'd be predisposed to be selling Canada.
We'll have more with Victor Adair right after the break.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Victor Adair. Victor, WTI crude oil was around $60 at the beginning of the year and briefly fell into negative pricing in April. Wasn't that interesting? In the past 2 or 3 months, it's traded in a range of between, say, $35 and $42 a barrel. What are the factors bearing on the price of crude, and where do you think it goes from here?
Jimmy, I'm going to be a broken record here with crude oil. I keep saying it's a lack of demand story. And I think that's really it. I mean, last year, the OPEC numbers anyway was that the world was demanding about 100 million barrels of oil a day. This year, it's a good 10% less than that. And even OPEC's forecast for next year is something like 96 million barrels a day. So we won't even next year, with the virus and so on, they don't expect the world to get back to demanding as much crude as we took last year. And certainly the trend for the past 10 years is every year there's been greater and greater and greater demand. So this is a pretty big swing. And speaking of OPEC, they're going to meet on the beginning of December the 1st. And I think what really they're going to try to do is to keep a lid on production or to limit production. But that's a bit tricky. You look at some of these countries make virtually all of their revenues by exporting crude. OPEC as a group, their revenues are down by about 2/3 from where they were in 2012. That they may think that's a long time ago, and fair enough. Prices at that time were over $100 a barrel. But you can't expect that their operating costs, let's say, have gone down anywhere near as much. So what that means is these countries, these producers of oil, need the cash, and they're going to continue to pump oil. And I mentioned Biden earlier, maybe being a little bearish for the dollar. Certainly, if Biden is the president, and I don't know that we know that for sure yet, but let's not get into politics. We'll see what happens. It's possible he may ease some of the sanctions against Iran, and they could very quickly, perhaps, increase their exports. Libya is bringing more back on stream. So there's going to be this pressure to maintain production while demand is falling. And the key fall in the demand side is transportation. And the key thing that's affecting transportation market is the virus. And my base case has been all year that this virus is going to continue to spread. And, we'll have our ups and downs on that, but as the virus continues to spread, it is definitely going to keep a lid on transportation demand. And so net, I'm not a buyer of crude, and I might look for opportunities to be on the short side of crude. I mean, we're going into winter. Winter probably increases global demand, 1 million to 2 million barrels a day over what it would take in the summer. So there is that. And there's always the short-term things, like, the inventory numbers and if there's a hurricane blows in and all that sort of thing. But just generally here, I would not be short-term bullish on crude.
Interest rates hit their lowest levels in hundreds of years earlier this year as central banks around the planet took dramatic action against the virus. A lot of analysts are saying interest rates will stay low for a long time. But Martin Armstrong, who was on this show recently, is warning people not to buy government bonds. What do you think?
Well, I'll tell you what. I've listened to Marty Armstrong, and had the opportunity, honestly, to a few times over the years to visit with him privately. That's going back a long time. I started listening to him in 1985, and read his stuff since then. And Marty's been pretty impressive with some of the ideas that he's come up with. Certainly, I remember specifically back in the early 80s, he was talking about, how the Dow Jones was doing such and such. It was at a certain level, but that it was making new highs. But in Swiss francs terms or Japanese yen terms, it wasn't. And that was important. And I thought, gee, I never thought of it that way before. So I've got a lot of respect for Marty. And at a certain time frame, certainly like over the next few years, I wouldn't want to be owning government bonds either. But then on a shorter term time frame, and let's just maybe do a segue there. That's just so important for folks that are thinking about, when they hear an analyst talk about something, is, you really got to figure out his time frame. And Marty doesn't usually talk in terms of short-term time frames. In fact, I know many times I've heard him say, people would probably do themselves a favor if they traded a lot less because, they just get caught up in the noise. But for me, a lot of my trading is focused in sort of a week to a couple of months kind of time frame. And in that time frame, I could trade be long of bonds, which I am now, and not worry about the fact that, I may never get my money back from the government. That if I just decided to take a long-term position in bonds, I'd probably be on the short side. Anyway, the what we call nominal rates, if you got a bank account that pays 1%, that's a nominal rate, did drift higher here the past couple of months. The rate I'm much more interested in is what we call real interest rates. That is the interest rate after you subtract the inflation out. And real interest rates in the United States on the 5-10-year bond tenor hit an all-time low on the 2nd of September, that key turn date that you and I have talked about a few times. And since then, those nominal interest rates have been heading a little higher. Still negative, but they're heading a little higher. And that's those interest rates. Negative interest rates are good news for gold, and if sorry for the muddle. If real rates are negative, that's very positive for gold. And if real rates are going in the direction of being not negative, that's not such good news for gold. I guess my base view on the bond market is that the bond market is not going to look past the dark winter to next summer being everything wonderful, the way maybe the stock market will be. I think the bond market is seeing that the economy could be struggling. could be rising unemployment, could be businesses shutting down. And I think if the stock market gets a little nervous, we'll certainly see some capital flow into the bond market. So that's kind of my base view as to taking advantage of a rather sharp sell-off in bonds. As I mentioned, when the vaccine news came out, the Pfizer vaccine news, the bond market fell very sharply. I didn't buy it that day. I let it steady for a couple of days, and I thought, I don't think it's going to go any lower, so I bought some bonds. I think there's just a huge gap between vaccines and widespread vaccination. And I think that might be something that the bond market's also paying attention to. So anyway, that we did hit the lowest level in nominal interest rates in hundreds of years. And I'm short-term bullish on bonds. Long-term, wouldn't touch them.
Victor, thank you so much for being on the show.
Jim, it's always a pleasure to talk with you, and particularly this year, there's just been so much going on in the markets. There's been no shortage of things to talk about, but it's just, if I could emphasize any one thing for our listeners here, just as a wrap, when I was saying about time frames, that is just so important in these very choppy, very emotional markets where there's a lot of things that could come out, and a lot of things just surprise you. I mean, that vaccine announcement was, how can you say it was a surprise? Everybody knows there's been all these companies that are desperately working on something, but when the thing came out, the announcement came out, we had the Dow Jones in the overnight market jump 1,500 points in an hour. So if you're trading out there, be careful. If you've got positions in the market, have some kind of a risk management in place, whether it's a stop or whatever it is you do. Maybe keep your size down, because I just think that we got some very choppy, emotional markets here, and whether you're bullish or bearish on something, you could still lose money. So be careful.
Thanks again.
Okay. Thanks, Jimmy.
My guest has been Victor Adair. His website, victoradair.ca. If you have any questions for Victor or any of our other guests, you can send them to info@housestreet.com. Find us on Twitter @HouseStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of House Street Media Incorporated.